Good morning and welcome to TOI Japan Market Radio, February 5, 2026. I'm your host coming to you from Tokyo with a briefing designed specifically for global investors tracking Japanese markets. Joining me today is our portfolio manager focused on Japan macro. Let's dive straight into today's session.
Thanks for having me. Today we saw mixed signals across Japanese equities. The Nikkei 225 closed at 53,818.039, down 0.875%, while the TOPIX held up better at 3836.0, slipping just 0.052%. The Mothers Index fell 0.632% to 2,201.0, and J Rights declined 0.122% to 2045.5. On the currency side, dollar-yen pushed higher to 156.881, up 0.694%, continuing its recent firm tone. Commodities were weaker, with gold in yen terms down 2.188% to 18,325.0 and crude oil falling 2.011% to 63.83.
That divergence between the Nikkei and TOPIX is interesting, especially given the relatively modest moves. But before we unpack the technicals, there's a significant development out of Washington that's generating attention among Japan watchers. Kevin Warsh, the nominee for Federal Reserve Chair, is reportedly facing substantial obstacles in implementing a new policy framework at the Fed. Why should Japan-focused investors care about internal Fed governance issues?
This matters enormously because Fed policy clarity directly drives global capital allocation decisions. When you have uncertainty about the Fed's operational direction or leadership cohesion, it creates ambiguity around the U.S. rate trajectory, which is the primary anchor for dollar strength and yield differentials between U.S. Treasuries and JGBs. If Warsh struggles to establish a coherent policy stance or faces institutional resistance, markets may start pricing in a less aggressive Fed than currently expected. That scenario would typically weaken the dollar and strengthen the yen.
And a stronger yen would be a headwind for Japanese exporters and equity valuations. How are you thinking about the near-term impact on Japanese assets specifically?
For Japanese equities, Fed policy confusion is actually a double-edged sword. In the very near term, if it delays aggressive U.S. rate hikes or supports broader risk appetite, the Nikkei and TOPIX could find support. However, if that confusion translates into genuine dollar weakness and yen strength, you'd see pressure on the export-heavy names that still dominate the index weightings. On the currency side, any dovish surprise or policy drift at the Fed would likely push dollar-yen lower from current levels around 156.881, and that's a material headwind for earnings revisions at Japanese multinationals. For JGB yields, reduced upward pressure on U.S. Treasuries would probably keep Japanese yields range-bound rather than rising, which diminishes the appeal of Japanese fixed income relative to equities but also reduces financing costs.
So essentially, Fed uncertainty injects volatility into the yen, and that's the channel through which Japanese markets feel the impact. Staying with the theme of market volatility, we're also seeing a tech-led sell-off accelerating across Asian equity markets today. Bloomberg is reporting that Asian stocks are falling as technology sector weakness gains pace. Given Japan's heavy tech exposure, how concerned should investors be?
This is definitely worth monitoring closely. Japan has substantial weight in semiconductors and electronics through names like Tokyo Electron, Advantest, Sony, and others. When you see a regional tech-led decline, it directly impacts the earnings outlook for these companies and weighs on investor sentiment toward Japanese equities more broadly. The Nikkei is already quite tech-heavy relative to other developed markets, so any sector-specific weakness gets amplified in the index performance. The key question is whether this is simply profit-taking after a strong run, or whether it signals deeper concerns about demand and growth momentum.
And how does that translate into moves across asset classes in Japan?
For equities, you'd expect continued downward pressure, particularly on semiconductor and electronics exporters. The magnitude depends on whether this is isolated sector rotation or part of a broader risk-off move. On the yen side, tech weakness often triggers safe haven flows, which would typically support the yen in the near term, though that effect could be muted if the decline reflects genuine growth concerns that might eventually require more dovish policy from the Bank of Japan. For JGB yields, you'd likely see some downward pressure as investors seek safety and hedge against potential economic slowdown, but again, the size of that move depends on whether this is a temporary correction or the start of sustained weakness.
So the nature of the sell-off matters as much as the magnitude. Shifting back to equities and market internals, there was an intriguing divergence in today's session that's worth unpacking. The Nikkei fell 0.78%, but the advanced decline ratio was actually quite strong at 1.61 times, meaning roughly 1.61 stocks advanced for every one that declined. Meanwhile, Nippon Sanso Holdings surged 7.94%. What do you make of that disconnect between index performance and breadth?
That's a really important observation, and it tells you something constructive about underlying market health. When you have a strong advanced decline ratio but the index still closes lower, it usually means one of two things. Either the large cap heavyweights underperformed and dragged the index down despite broad-based buying in mid and small caps, or there was profit-taking concentrated in mega cap names. The fact that breadth was positive suggests the selling wasn't broad-based panic, but rather selective positioning adjustments. Nippon Sanso's sharp gain is interesting because it's in industrial gases and materials, which often benefits from capex cycles and manufacturing activity. That kind of move suggests there's still selective demand in cyclical areas, possibly reflecting expectations around continued industrial investment.
So the internals are healthier than the headline index move would suggest. Does that change your near-term outlook for Japanese equities?
It makes me more constructive, yes. Strong breadth is typically a precursor to broader market strength, assuming the large caps eventually participate. Right now it looks like consolidation rather than the start of a sustained decline. If you continue to see breadth hold up in sector rotation favoring industrials and materials, that would be a positive signal for the medium term. The challenge is that we're also dealing with these external factors like Fed uncertainty and regional tech weakness, so the path forward probably involves more volatility before a clear trend emerges. For currency and rates, today's equity market chop doesn't have major direct implications. The yen is much more sensitive to macro policy shifts and rate differentials than to daily index moves, and JGB yields remain anchored by Bank of Japan policy stance and real rate dynamics.
Looking at the currency move today specifically, dollar-yen up 0.694% to 156.881, that's a fairly firm move. Is that primarily a dollar story or a yen story?
At these levels, it's mostly a dollar story driven by relative rate expectations. The market is still pricing in a Fed that's higher for longer, even with the Warsh uncertainty we discussed. As long as US yields stay elevated relative to Japan and the Bank of Japan remains cautious about tightening, dollar-yen has underlying support. However, if Fed policy uncertainty escalates or if US data weakens meaningfully, that support could erode quickly. The yen remains sensitive to risk sentiment as well, so any sustained risk-off environment would likely see dollar-yen move lower regardless of rate differentials.
And on the commodities side, we saw gold and yen terms down 2.188% and crude oil falling 2.011%. Does that feed into the Japan macro picture at all?
The oil move is more relevant for Japan as a major energy importer. Lower crude prices reduce the import bill and ease inflationary pressures, which gives the Bank of Japan more room to remain accommodative if needed. It's also positive for consumer spending power and corporate margins for non-energy sectors. Gold's decline in yen terms partly reflects the stronger dollar today, but also suggests risk appetite hasn't completely collapsed despite the tech weakness we discussed. If gold were surging, that would signal more pronounced safe haven demand and concern about systemic risks.
So pulling all of this together for our global investor audience, what are the key themes to watch going forward?
There are three main threads. First, Fed policy uncertainty is creating potential for increased FX volatility, and yen strength remains a risk for Japanese equity valuations, particularly exporters. Second, the tech-led weakness across Asia bears watching closely given Japan's sector exposure, but today's internal breadth signals suggest the market isn't breaking down broadly. Third, sector rotation toward industrials and materials could be an early signal of a capex-driven cycle, which would be constructive for Japanese equities if it continues. The challenge is navigating these crosscurrents, which likely means more volatility before a clear directional trend emerges.
And for investors with Japan exposure, the message is to watch both the external macro drivers, particularly the Fed and dollar-yen, as well as the internal market dynamics like breadth and sector rotation. Before we wrap, any final thoughts on positioning?
I'd emphasize that divergences like the one we saw today, where breadth is strong but the index declines, often create opportunities for selective positioning. The key is to focus on fundamentals and sector trends rather than reacting to daily index moves. Japan remains attractively valued relative to many developed markets, corporate governance continues to improve, and if the yen stabilizes or weakens modestly from here, the earnings backdrop is supportive. But staying nimble and watching those external risk factors is critical.